Hello, everybody, and welcome to our class. Today, we're going to talk about butterflies. What? Yeah, really, butterflies. How can you do butterfly strategies with options? We're going to see how this very popular and very exciting, I must say, strategy that can gain us sometimes a very nice but small profit with a very limited risk. And on the other hand, we can see that we can gamble. May I say gamble, but we can, like, say, let's have a hinge for 1 point in the market, and we're saying that it could stay there and the market will remain in this point, and we can make a very nice profit with a very limited loss potential. So let's see how it all works. Butterflies. All right, butterfly is a great one for the risk haters. If we're going on the short butterfly, we can see that our basic assumption of the market is that we don't know where the market is going to go. And don't feel bad about it if you don't know where the market goes, because a lot of people don't know where the market might go. But you're pretty certain that the market will not stay in this place for a very long time. Actually, it always moves, goes up, goes down, but you're not certain, you don't know, but you for sure want to make a small profit and take a, let's say, minor risk. So a butterfly spread is an option strategy combining bull and bear spreads with a fixed risk at capped profit. These spreads, involving either for calls or puts, or a combination of both, are intended as a market neutral strategy and pay off the most of it if the underlying moves prior to option expiration. Now, remember these key numbers 1, 2, 1, and we're going to talk about them really shortly. The short butterfly spread is created by selling one in the money call option with a lower strike price, buying two at the money call options, and selling an out of the money call option at a higher strike price. A net credit is created when entering this position. All right. The maximum profit is equal to the initial premium received, less the price of commissions. And commissions, it's a problem for those who pay commission for trading. And we're going to talk and see how they can be harmful for us. And the maximum loss is the strike price of the bot call minus the lower strike price less the premiums received. All right. Other words, let's see an example. All right. So our basic assumption is that we don't know where it's going and we pretty much don't care, but we just want it to move and make some money. So remember that creating a butterfly strategy, you can do it either by calls or by puts. So we'll give one example with calls and one example with puts. So for this example, we don't know, again, where the market might go, but just we hope it won't stay at its current position. And so, excuse me again, for this example, we're going to see that the strike price now at the market is, the underline is at 100. And we're going to sell one call 90. We're going to buy two calls 100. And we're going to sell one call of a 110 call option. So if we're going to do this strategy, we're going to see this kind of butterfly graph. As you can see, there is a, generally speaking, of course, there is a very bad point in the market that if it stays here, the current position at 100, we're going to suffer a loss. But on the other hand, that's pretty much enough. If the market moves, we'll see in the examples, even 1 or 2% up or down, we're going to initiate a profit. Now, how much profit we can make and how much money we can lose, it varies. It's very different, and it depends solely on the put options that you're gonna pay or receive from premiums that you're gonna get and buy. So therefore, I'm not giving any numbers, but this kind of creation of the butterfly, it could be a very good butterfly if you can get the right numbers, or in other words, the right money. You pay less and you get more money. So we're going to see how it works. All right, so this is the short butterfly. Now remember that in option, like in every trading, we can always see that there is the opposite, and there is the other side. And in this case, we're talking about long butterflies, which looks exactly but the opposite. That means that the other strategy that we can go short butterfly, excuse me, we go long butterfly. That means that we are pretty certain that the market is not going to go anywhere. And we're pretty sure it's going to stay here at this current level. And we can create this butterfly by this example. We can buy one put 90, sell two put 100, and buy one put 110, and we're going to get this kind of butterfly. And the strategy is going to look like this. If the market doesn't go anywhere, we're going to get a significant profit. There are going to be two break-even points that we cannot go below or higher than those two. But if it does exceed the break-even points, we're going to suffer a minor loss, which is okay with us because, we took a risk, but we didn't lose too much money. And for sure, we're not going to lose a lot of money. So maybe if you're a gambler or you want to, be somewhat, I don't know, certain with yourself or predict the future, and you're going to say, wow, at this point, I think the market's going to end for at least for the few days till these options expire. So I'm going to take my bets, take my risks, and build this kind of strategy. Okay, so now let's go. Now we're going to see how it works in real. I mean, I just show you the two examples of those two different strategies in butterfly, and now we're going to see how it works in reality over real prices. And there is a key factor here about pricing that is really crucial and very, very important for us to understand. So our underline today, we're going to see the examples on the QQQ. Everybody knows this one on the NASDAQ. And as you can see here, we have the option chain, and it goes pretty well every 2, 3, 4 days. We have different expirations. And let's see the short expiration that's going to happen. I'm going to close it. And it's going to happen 2 days from now. And the strike now is at 333.9. Let's say 333, and we can see this option chain here, and these are the prices between the calls and the puts. So let's see. First thing we need to do, let's say we're going to guess that the QQQ is not going to stay here for the next 2 days at this level of 333, and what we're trying to do is we're going to buy the butterfly and see how it goes. So as I showed you before that, we need to go one price below the strike price. That means call. Now also see, before you're starting, see the differences between the implied volatilities between the calls and the puts. On the calls, it's 10.88, and on the put side, it's 10.68. Pretty low implied volatility. So let's see. We need to first sell the 332 call option. You can see that there is a difference, and the prices are ranging between 2.4, let's say, and 2.5, let's say. You see the last one was at 250, but this is crucial here. So let's see, first thing we need to do is to sell one single, and let's say we're gonna get 240, okay, 245. And we need to buy 2 calls on 333. You see, we're building it here, and it's gonna cost us somewhere around 175. If we're gonna get this prices for real. Again, and we're gonna sell one out of the money call option, which is 334, and we're hoping to get at least 1.2 for this. Okay, again, these are assumptions. We might have those prices, we might have not, but let's see how the risk profile looks like. Wow, as you see, voila, this is our strategy. If we're going to get, and again, I'm saying it over and over again, if we're going to get those exact prices, 245 call, 332, 175, we're going to buy 333, and we're going to sell one at 334 call option for 120. We're going to get this kind of butterfly. Our max profit is going to be $15. Our max loss is going to be around 60. And if it goes well above 334, we're gonna earn also $15, whatever happens with the market. If it goes up or down, we're gonna make some $15. As you can see, this strategy requires a margin request of $100. It's not bad. And this is the basic strategy. Whether if you like it, then you can do it. As long as you can see here, we have a 33.99 is going to be our break-even point, and here also at 331.8 is going to be our second break-even point. And if it goes over to this side or this side, we're going to make some profit. But look at this crucial element here. That means we're playing the maximum for us is $15. That means that this is our all total net profit if we're going to make it. Now, take in mind that there's some serious issues here if you are paying for commission fees, because I don't know, in some broker companies you need to pay for those transactions, and each transaction, as far as I know, can reach up to $2, maybe even $3 as commission fees on each option that you're buying or selling. And in this case, we only have a $15 margin to play with commissions. That means that if you're gonna give us $2 for executions in options, and we're dealing here with 4 kind of options, that means that we're going to spend $8 more from our net profit. That means that our max profit will be $7, and here we need to also add those $8 to our maximum loss, which could reach above $70. So keep in mind that this margin is pretty tight, and you don't have too many options to play here. If you're not paying so much commission fees, then that could be a not bad strategy, and I sometimes strongly advise you to do it. It's pretty safe. You also know exactly how much money you're going to lose and how much money you can make, and see that the spread here is really small. That means that less than a quarter, something like a quarter, 1/3 of a percent for the market to move here or here, and you're in the money. Boom, that's not bad. Not bad at all. But keep in mind that you have to get here some kind of revenue, excuse me, when you're selling those 2 calls, and you got to have more than you're buying, because if you're going to sell it for even more, $1 more, that means that you're going to make here on this another dollar. And if you're going to make it to 250, let's say we're going to sell this call 332 for 250, that means that we're going to get $5 more. And also look here, our maximum losing point will be slightly less than 60, maybe a little bit more than 60, but every dollar that we're making, that we can make more than this, is just going to help us. As you see here, I'm adding some more profit for selling. And of course, on the other side, if we manage to get this, buying those two call options that we need to buy in a cheaper price, it does the same effect. So see, all in all we need is to sell it high and buy it as low as you can. Now, I know what you're thinking. Excuse me again. You're saying, yeah, let's take a risk. Sure, why not? I think that the market now is pretty high. So I'm not going to perform all those four options at the same time. I'm just going to perform right now the sell options. And I'm going to wait, I don't know, 10 minutes, hour, 2 hour, come back tomorrow maybe. And for sure, I'm going to buy those two call options that I need, way cheaper price. What I'm saying to you, what you're doing, if you're thinking doing that, then you're a pure gambler. That's a gamble. When you gamble, you might win, you might lose. And my advice to you is to give those perfect numbers and execute them at the same time. Just make sure you are on a revenue position. Otherwise, if you're going to gamble and think that you're going to get better prices later on, you're for sure, sooner or later, you're going to lose money. And that's my strong advice for you when you're doing it. Now, after I've said that, let's see another example. When the opposite, when we're pretty sure that the market is going to stay stable and nothing's going to happen, and we're certain that the market is going to expire at 333, so we can do the opposite, and we can buy 33, we can sell 334. We need to sell two of those, and we need to buy at 335. Now you see I've done that on 33, 34, and 35. And voila, we got this kind of butterfly strategy. There is no margin request here because we bought two calls and we sold two options, but we bought one outside of inside the money, in the money. And if it's going to expire at around 333, then we're going to make a whole bunch of dollars, almost $60 profit. And if it's not going to go there, then we're going to lose maximum of $23. That's a different kind of perspective. If you think that the expiration is going to be on this exact point. If it works well. You made $60 or nothing from the margin request. Another thing, another option that we can do is we can try and make something wider. We can go deeper. Let's say we go back again on this long butterfly, and we're going to do it on 330, excuse me, 335 and 340. Let's see, let's have a wider butterfly. So again, we're gonna sell one single here. Now the price is pretty critical here. We see spread here is between 4.03 and 4.2. Let's say it's gonna be 4.1. Okay, and we're gonna buy two out 335s, and it's gonna cost us, let's say, around 0.78. And we're going to sell out of the money 340. just a single one. And we're gonna get for this 0.6. Let's see how this. Oh, of course, we need to buy 2 of those. And that's why it's gonna look like that. Excuse me again. Now we've done this butterfly with a wider range from 330 to 340. And as you can see, now our max profit is going to be $260 on each side, but we got a greater break-even point. Reminding you that we have only 2 days to expiration, and we need the market to go well above 337 now and 332.5. Otherwise, between those two gaps, we're going to lose money, and we might lose a little bit more than $200. Now, because we have this wider butterfly, we need a larger margin request now. And that goes by $500. But you have greater chances for making more money if you're pretty sure that the market is not going to stay between those 2 points. Now, again, this is a considered a maybe plan, not bad also position, and you might seriously think that you can get those numbers. So then you can do it and take $250. That's not bad for 500 margin request. And let's see a different example, even wider and greater, also on the same expiration. Now let's say we're going to go 320. We're gonna sell one, and this time we're gonna get, let's say, 13.8, and we're gonna do it on 340. Oh no, it's a bit wider, too wider. So let's say we're gonna go on 330. We're gonna buy 2, and it's gonna cost us $4.15. Oops. And we're gonna buy, then we're gonna sell 340 for 0.6. Even greater, even wider. Now, look at this. First thing, our margin request is going to be $1,000. But on the other hand, we can make even greater revenue profit if it goes below 325 and 334 from here. You can see this is not a bad. This might not be as bad as it looks, but again, look at the belly size now. It reached 400. That means that you're in a risk of losing $400 if you're willing to take these chances, or making $500. Again, whatever happens to the market, whether it goes up or goes down, you're for sure going to make this profit. Expiration, you're pretty much zero because you're going to need to give 200 underlying stocks, ETFs in this example, but you're going to get also 2 ETFs. So all in all, total you're going to be zero. But again, make sure that your broker is not taking too many commission fees for those trades, and you might do pretty well. Again, as long as this stays here between those 2 break-even points. Otherwise, for sure, you're going to lose. Now, I don't know what to say. I don't know each one. It goes individually, whether you're a risk taker or not. That's not a bad. Usually, it's not a bad strategy. And when the market is volatile, it always comes to work. So you can make profit. Now, all depends. If you want a shorter range between those two break-even points, then make sure that you're getting as much money as you can get. And if you want to go wider, you can make more money, but take in mind that you're going to need to spend more margin request, and you're going to might suffer a greater loss. So that's it for now. This was a short example of the basics of butterfly strategy. I hope you enjoyed it. I hope you understood it. And I hope to see you in our next class. So may all of you have good luck and see you in our next lesson. Goodbye.